Can you just kick it off by giving us a sense of how the customers for your organisation are faring at this point after a series of rate hikes, but still somewhat resilient data crossing?
Yeah, no, absolutely. And good morning. Lovely to be here. Look, when we think of the customer base, I think what's really important is to look at some of our numbers in terms of the strength of their deposits. We're seeing also in their customer activity exactly what you mentioned. People are spending, they're using their cards more. So we can see the kind of daily transactions going through. And I think one of the important things that really gives you that strength of the customer base is actually what you mentioned on our impairment charge. It's 9 basis points for the year. That is incredibly low. You know, if I look back to pre-COVID, you'd expect that number to be closer to 20, 21, 22. So really overall, while there is concern and worry, and people are definitely worried, and there are pockets of issues, but actually overall in a very, very strong place. And that impairment number really supports that.
In terms of what could be the tipping point, though, Katie, and we're still setting up potentially for more rate hikes from here, cost of living crisis rolls on. What point do you think we start to see some of those delinquencies tick up in this cycle?
So as you look at it, we are modelling that we have no more rate hikes from here. You know, we're assuming 4%, which is built into our 14 to 16% return. But when I look at that impairment number, what the guidance we're giving to the market today is that will be about 20 to 30 basis points. So still not significant, but certainly a little bit of an uptick from here. I think one of the most important things, and the things that I look at more than anything, is what's happening to unemployment. It is still unbelievably low. We can see some differences in the number of vacancies and things like that, but while that number is low, what we can see is that the UK consumer is quite well protected from a lot of the pain that is felt through inflation and those rate hikes.
But Katie, it's getting worse, isn't it? I mean, I'm just looking at the average credit card rate here, and back in October, it was 21.46%. It's the highest it's been in over 20 years. This has got to start taking a chunk out of UK spending, surely.
Well, it's interesting. As you said already, the spending numbers were slightly better than we expected. What we can see is that people are still continuing to manage their credit really well. The level of pay down is continuing as it was. We're not seeing people moving from paying the maximum to only paying a portion or delaying some of their payments. So really very strong. I think one of the things that's important, if I go to pre-COVID, there are 100 billion more deposits on our balance sheet. So actually what people have is they have some pressure, some support behind them as they kind of face into that. And importantly, rates are coming down. Although the base rate is going up, the rate that I spend a lot of time talking about is the 2-year and the 5-year swap curve. And they have come down significantly over the last couple of weeks. If I think to sort of October, November to where they are now, we've seen sort of 3 percentage falls in that. And that has a real impact on what the prices of mortgages is, which again, you can see coming down. So actually, as you look forward, it does feel that actually, although the base rate might be moving, the anticipation is that will start to come down. And that's certainly our own assumptions as we move out of this year into 24.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.